Hey folks, welcome back to the channel. Today I'd like to talk about an option strategy that I've been using quite a lot recently, and it's called the ratio spread. It's one of the most flexible strategies available to traders and investors. How it basically works is you are long one option, but you are short two options. So it's a 1-to-2 ratio, that's why it's called a ratio spread, and usually the two strike prices are pretty close together. And because you're selling two options for every one option purchased, this is a net credit strategy, which means you get money upfront and time is on your side. So in this video, I'll be showing how to put on a ratio spread strategy, how to manage it over time, and a couple of real-world examples where I use this strategy for a bearish trade and a bullish trade just in this past week. So you can think of the ratio spread as just a tweaked short option. So for example, if we're going to talk about puts, let's say we're doing a put ratio spread, then that means we are bullish on the underlying and we think it'll go up over time. So I'll be using Apple as an example. Today is a weekend, so the market doesn't open, but let's say I'm going to put on a put ratio spread that expires on March 17th, the main expiration date for this month, because it's the third Friday. And looking at this chart, I'm pretty bullish for Apple because the green 9-day EMA is above the blue line, which is the 21. And also, it looks like it did find support down here at the red line, which is the 50 EMA. And also, the MACD is curling up and is above the 0 line. So these are all bullish signs. So the first thing you have to figure out is the direction. And in this case, because I'm bullish on this stock, I can go ahead and use a short put strategy on this or a put ratio spread. So for my strike, maybe I will pick something down here around 143 because that looks like a good level of support. So looking at Apple's option chain, I'm going to choose the March 17th expiration here at 143. This will give me a delta of roughly 14. And you can see I can make about $65 if I were to sell this put. And looking at the profile, this is what a naked put would look like. As long as Apple remains above 143, which is the strike, then I make the maximum profit, which is $63. I will start to lose my credit if Apple expires below 143, and my break even is 142.37. So as long as Apple stays above my break even, then this trade would be profitable. So now let's compare this to a ratio spread. I'm going to clear this. For the put ratio spread, if I want to make roughly the same premiums in this case, I'm going to choose around the same strike price, but maybe a little bit higher. So at 144, I'm going to sell a put option. And at 145, I'm going to buy a put option. And over here where it says sell, I'm going to add two quantities to this. So this is what makes it a 1-to-2 ratio spread because I'm long one option, which is the higher strike, and I'm short two options, which is a slightly lower strike. And if we look at the profit loss profile, you can see now this looks a little bit different. Instead of just a straight line and then going down, we actually have this little cat ear shape here where I can make a lot of money if Apple ends on March 17th between 145 and roughly 143. And why is that? Well, because I'm long the 145 strike, which means as the owner of this put option, I want Apple to actually go down. And the lower it goes down, the more money I make. In fact, if it doesn't go below 145, this option that I own becomes worthless. But because I am short the 144 options, I don't want Apple to fall below here because that is when these options will start to have intrinsic value at expiration. And because I'm short these 144 options, I want those to expire worthless. So the maximum profit, the ideal price that I want Apple to expire at is 144 because that way I can get the maximum intrinsic value from my 145 put option that I own. But 144 is still high enough that my 144 strikes for my short options will expire out of the money or expire with $0 of intrinsic value. So that's why the graph looks like this. I'm basically going to make a $58 credit as long as Apple stays above 145. Actually, I get to keep the credit no matter what, but if Apple stays above 145, then all I do is keep the credit of $58. And this is why this strategy makes money most of the time, because with the strike price of 145 over here, you can see the delta is only at 18.7, which means more than 4 out of 5 times Apple is expected to expire above 145 because the price today is at 151, which is quite a bit higher. So most likely Apple is going to stay above the 145 mark, and I'll just keep the $58 in premiums. If it closes between 145 and 144, this is when when I will start to make a lot of money because my 145 put option that I own will have intrinsic value, and that is good for me as the option owner. However, once it gets to 144 and below, then even though my 145 put option still has intrinsic value, in fact, the lower that goes, the more value it has. So I should be able to make more money from this 145 that I'm buying. However, because I have two short options at 144, the lower it goes below 144, the more intrinsic value those short options are going to be worth. And that's why I'm going to be losing money on those. And because I have two short options for one long option, overall, if the underlying continues to go down, the losses from my short options are going to override the gains from my long option, which is why this is going to slope down. If you look at my break even, it's going to be 142.42. So this is roughly the same as if I just sell a naked 143 put option in the previous example. So if I put these charts side by side, the one on the left is just the short put. I'm going to make just over $50, it looks like, by selling the 143 strike. And as long as Apple stays above about 142.5, that put option should make money. For the ratio spread, I'm going to make $58, so about the same. And my break even is also around the $142.5 mark. But the biggest difference between these two is this little bump right here, that cat ear, which means if Apple falls within that range, then I'm going to make a lot of money. The maximum return here, as you can see, is 158. That's at the top of this ear right there. And that's basically at 144, where the stock price is just high enough where it doesn't trigger my 144 short puts, but it's still low enough to trigger a pretty sizable gain, like $1, which is like $100 from my 145 long put position, right? So that's why the max return is 158, because I'm making $58 just from the credit spread because I'm earning $78 times 2, but I'm paying $98. So the difference between these two transactions is the $58. But then on top of that, I have another $100 in intrinsic value that I can potentially make if Apple finishes it at 144. And you can also control the width of this cat ear, for example, by making the spread bigger instead of just $1. I can widen the spread, and the bigger the spread, then the bigger the potential payout. And that's because there is a vertical spread built into this ratio spread strategy. And of course, the bigger you make the spreads, the more money you make. So for example, if I still buy the 145, but then I choose a 143 strike to sell, so this is a $2 spread now, and I can type in here 2 for the number of puts sold. The maximum potential gain I can make is more. However, the trade-off is I'm going to be making smaller premiums, meaning I'm going to collect less credit. So let's take a look at the profile for this now with a $2 spread. So same expiration date and everything. As you can see, instead of making $58 for the credit, I'm only going to be making $28. But instead of the max return being 158 like before, well, now it's 228 because it's the $28 plus 200 if Apple closes right at 143, which is the strike of the short option, which means I'm making the entire intrinsic value between 143 and 145, which is a $200 spread. So that's how you can increase your max return, but you have to be aware that the credit spread that you collect right away is going to be less. So it's important to understand that relationship. Now, there are other things you can do if you want to increase your credit earned right away. For example, instead of a 1-2 ratio, let's do a 1-3 ratio. So I'm selling 3 puts instead of just 2. And now my credit earned is a lot more because I am selling 3 puts at 63. So that's like $189. And I'm only buying 1 put at 98. So the difference between what I'm getting for selling 3 put options and paying to buy this 1 put option is about $90. And you can see by this line here, it's $91. But now you can see that one of the risky things about doing it this way is that I really have to be confident that the stock is not going to drop too much. Because if you look at this line over here on the left, this is pretty scary because it's basically at a steeper slope than before, right? So before the slope was more like this line on the right side, it's not as steep, but now it should be twice as steep because instead of just having a net short of 1 put, I'm actually net short 2 because I sold 3 puts and I bought 1. So if Apple really goes down, then I have 2 puts to consider, and that's going to lose me a lot of money. That's why you can see the max loss here is $28,000. Whereas if I do a 2-to-1 ratio spread like before, then the max loss should be about half of this, like 14,000. So let's just set this back to 2, and the max loss goes back to 14. and you can see the slope on the left is now the same angle as on the right again. But of course, my credit earned goes back to 28. So those are some things to keep in mind when you're putting on these spreads. Personally, I like to keep my ratio spreads at a 1-to-2 ratio, and also for the strike prices, I like to keep the spreads pretty thin. So either like buy 145 and sell 144 two times, or buy 144 and sell 143 two times. And keep in mind, you can use put ratio spreads if you're bullish, like this Apple example I just showed, or if you're bearish on the underlying, then you can just use call ratio spread, which is the same thing, but I'm going to be showing an example of a bearish trade with a call ratio spread that I made with TLT, so you can see how both sides work. Now, in terms of when I would use the ratio spread, first of all, like any credit spread strategy, this is really good to use if IV is high. And one way you can filter by that is through IV rank. So in Interactive Brokers, I have my IV rank set up here for each underlying for the stocks that I like to track. And if IV rank is over 40, then that is usually a good candidate for me to use a ratio spread on. So the higher the IV rank, the more volatile the underlying is expected to be relative to its previous trading sessions, which means you can collect more credit using this strategy. So because of that, another good time to use this is right after earnings. So for example, Apple's latest earnings came out on February 2nd after market closed. And then the next day, February 3rd, the stock closed the day up. So IV is going to be very high on Thursday and Friday, especially Thursday. So after you see the market's reaction to Apple, then you can decide whether that's bullish or bearish for the stock over the next week or so, depending on how long the duration you want this ratio spread to last. And then you can do a put ratio spread or a call ratio spread. So for example, after earnings, the stock went up on high volume, which basically tells me it's bullish. So even if the stock were to drop over the next week or so, it's probably not going to come back all the way down to the previous lows, like down here. So you can do like a put ratio spread 1 week out with the strike around 144 or 142. Also look at the overall direction of the trend over the last couple of weeks. You can see Apple was going up before earnings even came out. And because investors liked earnings, pushed the stock up. That's just more reason for the stock to continue going up. So a put ratio spread would be a good choice here, because if the stock continues to go up, then you basically just make the credit spread and earn a profit. But even if you're wrong and it goes down, well, it just beat earnings. So how bad can things get in 1 week? Especially when it has all this momentum behind it, like the green line, blue line, pink line are all going up. Now, in terms of how to manage your put ratio spreads, basically if the stock continues to trade above your long option, so in the example with Apple, I'm going to use 145 as my long, and I'm going to short 144 twice. So if I were to put this trade on today, 145 is here, and this is my 144 short put. And March 17th is right here on a Friday. So if Apple just goes up and down all around here, but it doesn't go below 145, then I just don't do anything. I let all the options expire worthless, because put options only have intrinsic value at expiration if the underlying is below them. But if Apple just stays above, then my long options as well as my 2 short options all expire out of the money. I basically collect the $58 in premiums, and that's it. But if Apple drops to this line, then there's a couple things you can do. First of all, if it drops to 145 and it's pretty close to the expiration date, like maybe it's just 1 or 2 days away, then I would be inclined to not do anything and just wait until like the last possible moment before the expiration. Then I might sell the 145 long put for whatever intrinsic value it's going to have at that time if the stock goes below 145. Because if there's only like 2 or 3 days away to expiration and the stock is at 145, then remember, if it goes down a little bit, you have all of this all the way until like 142 and a half. You're basically still profitable. So there's not a lot of time left in that case for Apple to go down below 142.5. It has an equal chance of going down another $2.50 than going up $2.50. But if it finishes maybe like $1 or $2 lower, then that's actually around the maximum profit you can make. So if these situations happen enough times, chances are you are going to be more profitable than not. So let's say by March 15th, so 2 days before expiration, this dotted line is where the value of this strategy would be at that day, and it looks like it's pretty much at zero. So even though this combo in your portfolio will say, you've made $0 on this, I would just hold on to it for another 2 days and then see. Because if you were to close this position, then you basically break even right now with this strategy. However, if Apple goes from 145 to like 144 or 143, you're still going to be making some money because the break even is 142.42. And then on the final day of expiration, if there is intrinsic value to your long put, so if Apple goes to like 144 or 144.5, then you can close this position, and not only will you have collected the net credit from the beginning, but you can also make some capital gains by getting out of both the long and short puts. Now, what if the stock drops earlier and it reaches 145 before? So let's say after a week or so, for some reason the stock is already at 145. At that point, I would be inclined to get out of the position. I would not wait until the stock drops to like 144. So let's say 1 week into the trade, instead of 15th or 16th, let's pick somewhere in the middle, like March 12th. If the underlying goes to 145, then it looks like the loss will be about $57. So if you win, most likely you'll make $58, and if you lose, then you lose $58. But the idea is, because the underlying stock price right now is 151 here, most likely you're going to take a win with this trade. Plus, you have the added benefit of near the left end between 142 and 144, you get to that cat's ear where you can make potentially a lot more than just the $58 in net credit. So that's one option, is to just take a loss, and then hopefully next time you can make back the gain, because in most cases this trade will be profitable. As you can see here, profit probability 89% in this particular case. The other thing you can do is roll this forward to a future date, but you have to be careful with rolling, because if Apple goes down lower, then you could actually be at risk of taking a bigger loss than if you just take the $58 loss right now. So the thing with rolling is you better be sure that the bottom is nearby. But that's why getting the directionality is so important, because if you're bullish on Apple and you think it's going up, then it's not likely the stock is going to come back down and go below 145. But just in case it does, those are a couple things you can do. And if it's your first few times doing this, you can also put in a max loss, like maybe 2 times or 3 times, meaning my credit for this is 58. So at any time, if this option is, let's say on March 9th, you can see here it goes down to like 100 and minus 116. So if on March 9th, Apple falls to 144.5, March 9th is here. So if Apple drops down to like here, for whatever reason, it fills this gap, then obviously my idea that Apple would go up is wrong, and it's fallen through the bottom of this channel. So I would just get out of that position like right away. So this strategy is really good if you get the direction right, or even if you get the direction wrong, but you're wrong a little bit, that's still good, because you not only collect all of the credit, but if the underlying price goes against you a little bit, especially near expiration, then you also have the benefit of making a spread between the long and the short options. Okay, so now let's look at some real life examples. So we'll look at a bull case first, and I will use the SPY ETF, which basically just tracks the S&P 500. So this is looking at the daily chart, and the black line here is a 200-day moving average, and it recently bounced off of that. So I believe it's currently in this red bear channel, and it goes from the bottom to the top to the bottom, and I think it's going to go back to the top. The MACD down here is also showing that it's starting to curl up, because this is a faded red bar compared to the solid red bars, which has been going down. Plus, it's really far away from this blue line here, which is the 21 EMA. And usually the market likes to backtest and does not go too far away from this, either if it's too high or too low. So today is Monday, and I'm going to be putting in a trade that expires this Friday. So a weekly option trade. And because I think this is going higher, I'm going to put in a bullish put ratio spread. But just in case I'm wrong and the market goes down, like if it's too weak to go to the top of the channel and it reverses and goes back down, so it ends Friday down here, I think the lowest it can reasonably get to is the bottom of this channel. Looking at the option chain here, so if the lowest is 388.5, which is between here and here, I'm going to sell a strike price above that, so maybe 390. And because I have to sell 2 puts and buy 1 put, I can either sell the same put, so I would just double up on this, or I can sell a 391 as well. And then the one I would buy is the 392. So the profile would look something like this. If the SPY finishes above 392, then I will be making about $46. If it goes between 392 and 388.5, then that's where it gets interesting. As you can see, that's when I can make a lot of money, like 146 at the top here, between 190 and 191. However, if it falls below 388.5, which is my break even right here, then that's when I will start to lose money. So looking at the chart here, 392 would be this green line here, and then 388.5 would be this purple line here. So basically, right now we're at the middle of this channel, and I'm betting that SPY is going to finish above 388.5, which is right here, because the last touch of the sides of the channel was on the bottom side. So it would make sense for us to go higher. And if it gets between this purple line and green line, of course, that's when I will make the most money. Okay, so I'm going to put this trade in. Looks like I can get a little bit more for it, so I'll put in 155, which is the bid. Okay, I'll drop this down to 154.
Order filled.
There we go. So that one just got filled at 54 with 462 in commission. So that's about $50 of net premiums after commission, and we'll have to see how this goes. Most likely, all of the options will just expire out of the money, these three here, because SPY is going to end above 392. Currently, it's at 398, so it's pretty high. But if it finishes between 392 and 390, that's when I'll be making a lot of money, and I can close this entire position for a net gain above $54. Okay, so now let's take a look at another example, and this one I'm more bearish on. So this will be TLT, which is the iShares long-term bond ETF. And this index fund basically tracks long-duration US government bonds. So if interest rates go up, then you would expect this to fall. Looking at the daily chart, it seems like it's just continuing on this downward trend, and it's having a really tough time going above this green line, which is the 9 EMA. So if I draw a line here where the green line is now, it's about 102, and this Friday is going to be right here. The MACD has fallen below the zero line, and it's continuing to go down, and it doesn't seem to be curling up too quickly. So I feel like by the end of this week, it could potentially reach all the way down here because that was the previous low from December. Especially the last 3 days, there were these wicks going down above each of the bodies, which means the ETF did go up, but it closed a day lower, which shows weakness. So I think it's going to be hard for TLT to go above 102, although there is a gap right here in mid-February. So if it does fill that gap, you would expect the ETF to end around 103. But because there have been so many days where the green line is resistance, it's just not very likely over the next 4 days until March the 3rd for TLT to go above 103. So overall, I'm bearish on this since the green line and the blue EMA are both pointing downwards. So looking at the option chain for TLT, I'm going to take 103 and go up $1 to maybe 102, and I'm going to sell this one and maybe buy the 101.5. So instead of selling two separate strike prices, I'm just going to double up on this 102 strike. So looking at the profile here, now the ear is on the right side instead of the left side. 79% chance of a profitable trade, so that's good. And if the stock ends below 101.5, then I get to keep, it looks like about $18 in premiums. And between 101.5 and 102.68, which is where this ear is, that's when I could make the most premiums. And I lose money if the ETF moves above 102.7. And that just changed because the premium fluctuates in real time. Okay, so maybe I'll start with 25 as my credit. And because this is a smaller ETF, I'm going to choose 2 as my quantity. Okay, I'm going to drop this down to maybe 23 cents.
Order filled.
Okay, so my TLT bear ratio spread has been filled as well. So hopefully SPY doesn't go down too much and TLT doesn't go up too much. Let's see how things play out by the end of this week. All right, so it is now Friday and there's just a few minutes left in the day for trading. So let's take a look at how those ratio spreads did. Let's look at the SPY first, which I was bullish for on Monday. So that's this one, 390, 391, and 392. I was short these two, and then I was long the 392. So it looks like SPY is going to finish above all of those. So 392 would be like all the way down here. So on Monday, which was over here, I said most likely because we've bounced off the 200-day moving average, SPY was going to head higher. Looks like it did. So all of these three options are going to expire out of the money. As you can see, the market price is going to be 0 by the end of today in the next couple minutes. So the total profit will be 49. Now for TLT, I mentioned this one. I had a feeling it was going to go down. It did go down Monday, Wednesday, Thursday, but today it popped back up and it's going to close at around 101.89. So I wasn't expecting such a large move up, but for the ratio spread, TLT here, it actually turned out to be pretty good because now if I open this up, you can see the call option, the one I'm long, is actually worth quite a bit of money now. So I can actually sell this and get some money back. Meanwhile, the 102 call is going to be worthless. So I'm just going to close this one.
Autofilled.
And that filled at 35. And I don't have to worry about the 102 call because TLT is at 101.86 and there's just like a minute left of trading in the day. Okay, it is now 9:55 Pacific. Let's take a look at where things landed. So my 392 long put that I paid 1.08 expired out of the money because SPY finished at 404. But what that also means is that these puts that I sold at 390 and 391, these expired out of the money as well. And since overall I made more premiums from these two than I paid with this one option, I gained a net of 49, and this unrealized profit of 49 will become realized. Now looking at the TLT, the underlying went up pretty much all day today and ended right here at 101.89. Technically, I should be closing the short leg as well. That's the proper way of doing this strategy. If this had been a little bit higher, like 101.92 or 93, which is pretty close to my 102 strike, then I would have closed this as well. But in this case, I decided to just leave it because I think the risk of assignment is fairly low. And in after trading here, you can see there's not much volume and it looks like the price is staying below 101.93. So at the end of the day, my 102 short call expired worthless. Okay, so just to review the performance for SPY, I made the trade when SPY was somewhere around here at 398, and I thought the ETF would go higher towards the right here, and it finished at about 404, which is right here, and that means I've made a profit at $49. And really, it could have closed anywhere above around 392 and a half, and I would have made the same amount of money. And then for TLT, this is the daily chart. You can see I put in the trade on Monday at around 101.28. So that would be around here. And I was expecting the ETF to go down towards the left there. And it actually went down for most of the week. But that one day today on Friday pretty much engulfed the entire 4 sessions previously. Actually, 5 sessions if you include last Friday. And because it actually ended at 101.89, it's actually right here, which means it's within the inside of this ear, which is why I was able to sell my 101.5 long call option, because this one, I was able to get some value there between these two arrows. So my actual profit for this is, it looks like about $50 per strategy, and I believe I had 2 of these because I bought 2 calls and I sold 4 calls. So let's take a look at my recent trade here for TLT. So I sold my long calls, the 101.5, for $35 each. Originally, when I placed this trade, I was able to sell the combo for $23 each. So my total profit for this would be the $23 that I made originally for each combo, and then just add the 35 on top of that, which is $58 per combo. And because I have 2 of those, that's $116. And if we subtract commissions from that, that would be $7.15 for Monday's transaction, minus 90 cents for today's transaction. So it's about $108. So that's actually twice as much as I was expecting to make. Because had TLT closed pretty much any point left of 101.5, then I would have just made $25 per combo. And then my total would be 50 instead of 108. But you have to be careful because if TLT closed at 103 today, then you can see I would actually have a loss at about $30 or $35, and that's per combo. So you would times that by 2 to get the total loss. So with ratio spreads, you have to watch them and make sure you close out early to cut your losses before things get too bad. Now, in my case, things actually progressed quite well, so I didn't have to close out my positions early. So there you have it, ratio spreads. If you're pretty confident in the direction of a stock or ETF, but you also want a chance to make a lot of money in case you get the direction wrong a little bit, then this is a good strategy to implement. Now, I did these couple of examples on a weekly time frame, but you can do monthly or quarterly. I wouldn't recommend anything shorter than weekly because the premiums are not really worth it and there's a lot of fluctuation. And if the underlying moves up or down a lot in a single day, then that can definitely hurt you if you're on the wrong side of that trade. But hopefully you found that interesting and will consider the ratio spread as part of your arsenal for options trading. Let me know if you have any questions. Thanks a lot for watching. Good luck with your investments, and I'll talk to you in the next one.